Happy Aloha Friday, everyone. Today's episode, we revisit the CPI report that just came out on Tuesday. For the month of January 2023, we review some of the changes in the variables and the weights that they decided to use in their calculation. We also take a look at net present value and net future value and how that can be a benefit to your practice. Hope you enjoyed today's episode. Thanks for joining us. The Healthy Practice, Healthy Patients podcast, where we focus on the health of your practice so you can focus on the health of your patients. Here we keep you updated on current events in the marketplace. I'm Drew.
And I'm Tanya.
All right, let's go. Let's get into it. So it sounded like you got some interesting things to share with us.
Yeah, I think I was just starting to kind of look through their formula change that you talked about, get some context there as to maybe why that change happened and what the change reflects, what it means, how it possibly impacts, that data. What I thought would be cool to share to provide maybe a parallel to helping to understand, maybe why that change was necessary. So from what I saw, and correct me if I'm wrong, Drew, and maybe hop in too, that change in that formula reflects data from 1 year's worth of info as opposed to 2 years worth of info. And that the info included is going to be weighted hopefully according to consumer spending, right? What are they noticing in the trends, in the shifts and cycles possibly? So how you're seeing maybe some more increase of representation from housing and goods, and maybe some decreases in other areas.
Yeah, I was a bit of a skeptic last time, but the more I looked into it, it made more sense, right? To adapt to what consumer spending looks like and make sure it's a more true, accurate reflection of that. Yeah,
totally. And that's kind of what I felt as well. And I thought to kind of explain why that would be a helpful approach would be to just maybe use the example of inflation of CPI over time. So let me go ahead and share screen. Okay, so this is, maybe I'll just zoom in, CPI data for the US, and I limited the chart, the info from 1990 to 2023.
Okay.
So we're looking at this column, the annual column, on down.
Okay.
And so, over time, you're seeing, 5% from 1990 all the way down to this most recent report of, 6.2.
Wow.
And I thought it would be, kind of helpful to provide some context. I think at times, because we're living on the day to day, and oftentimes the immediate effects of things feel so real and feel so upfront in our face. But kind of how you've been emphasizing taking maybe a more long-term approach to business practice and to perspectives even. I think the same can be true when we're looking at information, economic data, where we are, excuse me, in this data. If you take the average, this info from 1990 to 2022, I think when I calculated it, it was like 3.4, 3.6%.
Oh, wow.
And, so all that is saying is that over time, these ebbs and flows really do kind of balance out, right?
Right.
But if we are limiting to 2022 alone, we're seeing and we're feeling this 6.2%. And so, the way I saw this shift in the CPI formula, this calculation as before calculating on a 2-year period, and now condensing it down to a 1-year period, might hopefully, in theory, provide some more immediate relief as opposed to being spread out over, a longer period of time, where some of those short-term fluctuations are balanced in over a longer period. The hope is that condensing it down to maybe 1 year, you'll feel more of that immediate relief to kind of speak more directly to just what, as a consumer, you're experiencing now. Because like we've seen, taking maybe the cost of gas as an example, the cost of gas over the past 2 years has fluctuated immensely. And it is nowhere near where it was, 2 years ago, but there's been lots of fluctuations there. And so to limit that info to a 1 year period, might be good for consumers so that the immediate effects are hopefully reflected and then in turn felt, would kind of be how I looked at that info. But curious what you think.
Yeah, that's awesome. Thanks for showing that chart. I think provides a good perspective. And it's nice to, over 30-year span, take the average, and and like you said, we're about 3.5% for the average over that time. What I was kind of thinking is, there's this principle of, net present value, net future value of money, right? When I remember this lesson in seventh grade, what's the value of a dollar? Like, oh, it's a dollar. And he says, wrong. It's whatever you can get for the dollar.
Mm-hmm.
And I'm like, oh, that doesn't make sense to me, but a dollar is a dollar. I'd love to have a dollar, right? Because in middle school, we had a Snapple machine where you can go and buy drinks. And at that time, they were 50 cents. So with a dollar, I can get 2 Snapple drinks. And for me, that would be a really good day. Anyway, so what I think about, a dollar is whatever you can get for a dollar. It's whatever you can get at this time or at any point in time. So over that 30-year period, you're saying on average, year over year, increase of 3.5%, meaning the value of the dollar every year depreciates every year. So if it's 3.5%, what does that mean? The cost, the strength of your value of your dollar can buy less, purchase less. So it requires more dollars to purchase the same thing. And I think that's what you're saying with the increase in gas prices going up. The strength of your dollar is lower. And so you can buy less gas. So it requires more money. Right? At the end of a year, depending on your business model and on your profitability in your practice, sometimes there's a little bit of a profit sharing that a dentist will do, depending on the performance and production of your team. Usually you like to reward your team, usually around Christmas, and share, your profit bonus. Thinking in terms of net present value or net future value of that $100, who would it benefit to give the $100 right now, during the Christmas season? We are now in a time of inflation, and so the value of your money is going to decrease over time, right? And so 6.5% was the January report. So the $100 a year before is now worth $93.50, right? So it's which is, and like you were saying, we all feel it as consumers. We all feel it, but we don't know what's going on. And I hope this example kind of helps. So if you're going to give your employees $100 right now, over time, that value of the $100 is going to decrease. As a business owner, what can I do with $100? Would I be doing a service to my employees by giving them the $100 right now? Or could I give them the $100 over the next 2 quarters, right? So instead of $100 right now, maybe I'll give you $50 now, $50 later. But what happens to the value of that? It goes down. So the $50 right now is as strong as it's going to be here during the holidays. And then the $50 that I give in a quarter from now, that value is going to be lower. Which one's better? It depends on the situation. We've been talking about staff shortages, staff depletion, right? And maybe perhaps giving them that initial relief, $100 in bulk, would serve your office, your team better now. But if your team is more committed, perhaps they would benefit from $50 now and $50 later, even though the value of the money is decreasing over time. That would be a strategy perhaps that you could look into. Yeah,
That's really great insight, Drew. I love that. Just thinking of the power of the dollar
Mm-hmm.
today versus whenever it is that you're going to be sharing it with employees, if that's something that, as business owners, they're going to do. Kind of makes you, like you said, think about the most optimal way to share some of those extra benefits, profits that they might be generating over time. Thinking from a planning standpoint, um, you bring up such great points with inflation and the value of your dollar depreciating over time. So what are you going to do with your dollar to keep up with the times, keep up with inflation, and make sure that you are able to afford kind of the cost of living every year? Oftentimes this is where they talk about investing, the power of investing.
Right.
And so, speaking specifically as a business owner, I'll throw out that there are, if they are already offering different benefits, possibly maybe a 401k plan as a benefit to their employee, there are different types of plans where you can add specific options that allow some flexibility with the sharing that they provide to the matches that they provide to their employees. These matches, whether it be profit sharing or safe harbor match, whatever it be, these contributions go into these 401k accounts that are then invested accordingly, right, into different funds that can accumulate interest and growth compound over time for these employees that maybe might be able to take care of themselves now, but in the future, if your dollar amount that you're paying out remains the same over time, it might be worth looking at, how to possibly couple it with some type of investment option to where growth over time will not only meet kind of the inflation that you're seeing over time, but maybe a little bit extra on top of that, right, over time.
Yeah.
Right. And so there are some of those options available in your plans. If they have 401k plans, for sure, to talk to their plan administrators what some of those options are. Especially if they're having fluctuations in their profit and their bottom line every year, there are plans that allow a little bit more flexibility to where you don't have to do a set match every year, but maybe a variable amount to your employees. So
Yeah. Here in Utah, I've been looking at this Facebook page, and there's some real pain going on right now. I was trying to take the tally of every post in this Facebook group, and the number is between 10 and 15 posts every day from different dental offices, different employees saying, "Hey, I'm available for temp work." So this is the secondary market that I was alluding to in the last episode. So there's some real pain going on, and there's a real, exodus that's happening in dental practices, which is really unfortunate. The going rate for a dental assistant right now, is right now is $25 to $30 an hour. That's a lot higher than it was just 2 years ago, right? It's almost doubling. And so that's the type of leverage that these employees are being rewarded with when they go into the secondary market. Now, the more of them that go into it, the more supply that there is. And so with a higher supply to meet the demand, the price that they can leverage hopefully will come down to more, normal market prices. So hopefully that will return, but we'll see.
Yeah. Oh, that's crazy. What Facebook group is it? I'm just curious. So it's just a dental
Yeah.
Facebook group?
Yeah, I don't know.
Gotcha. Based here in Utah, or is it dentists
Yeah.
kind of everywhere?
Yeah, just here in Utah. So it's like a Utah Dental Network or something like that.
Gotcha.
Yeah. It'd be easy to find. I think there's only 2 groups, and I just got accepted into the one.
Congrats.
Thanks. It took them 4 months to approve me, but once they found out that I'm not a threat, whatever that is.
No, yeah, thanks, Drew. This kind of took me back to just planning days, and when we're doing projections for people for 5, 10, 15, 20 plus years out, we're using an average of the data as our base assumptions to run some of these numbers, you know. And so it's always kind of taking stopping and looking at what's going on most immediately. I do have to remember that these short-term effects are being very felt right now by many people, because I think at times, especially you know, in planning, we take a long-term perspective and we see the numbers kind of averaged out. And so it's nice to kind of just be reminded that these immediate effects are felt very strongly by, probably maybe even disproportionately sometimes by some. And it's good to just be mindful of that in dealing with people. So good insights.
Yeah. Well, thanks, Tanya, for your insight and your help. I guess we'll call it a week. Hope it's a good weekend for you, and we'll see you again next week.
Sounds good, Drew.
All right.